The money's starting to run dry for people.
Yeah.
They were up hundreds of thousands of dollars in equity. They had money in the bank. It took a year for that money to start running a little bit dry and to start feeling a little bit tight in their wallets and to stop feeling as rich. Now your stock portfolio is down. The equity in your home is worth less. You're not paying off your mortgage anymore. Now consumers are going to start adjusting their behavior. What's up, everybody? Scott Ascenta here, back with Pritish Raval on another episode of Leverage. We just had an interest rate announcement. That's going to be one of our topics of discussion. We've got Musk fighting Zuckerberg.
That's right.
And before we get into that, Pritish, how was the weekend? What's going on in your world? How's business? How's life? All that stuff.
Weekend was great. Wonderful. Business is steady. Actually surprisingly busier than I would have anticipated, which is obviously a positive. Yeah, heard about this Elon Musk versus Mark Zuckerberg.
Nailed it.
Facebook guy.
Facebook, yeah.
They're about to apparently fight, and it's a real thing, or they're talking about fighting. And then we saw a picture of Zuckerberg training with Adesanya. You had a great comment about that. Maybe you want to share why he was training with Adesanya.
He was training with Adesanya because I was busy, so I was unavailable.
Yeah, he actually said
a little
that.
bit forced.
Yeah.
A little bit.
There
forced.
we go. So that's what's happening.
Yeah, I think it's all smoke and mirrors, just drama news. I don't think it's actually going to happen, but we shall see. What do I know? Are you seeing, like on the business side, are you starting to see distressed sellers now? There's a lot more fears picking up. We're going to get into the reasons why this is playing out the way it is. But what are you seeing on the mortgage side? Are you seeing distressed sellers? Are your previous buyers calling you up, hey, I got to get out of my house, I can't afford the payments? Are you seeing any of that stuff?
No, honestly, not too much of that, to be honest. For the most part, a lot of clients are calling, and if they're still in variable, they're converting now, right? Because I think, they're kind of feeling like maybe there's the end in sight that we thought was close is maybe not as close. So some of them are converting to the fixed that had held on this far, but nobody calling in saying, I can't afford it, need to sell. People are adjusting. They're adjusting their lifestyle as well, I think, at this point. So at least that's what I'm experiencing. How about your end? You're getting some calls from sellers?
Yeah, same. The only sellers I'm getting calls from right now are investors that are heading into either break-even territory or negative cash flow territory. And as an investor, you don't want to be cash flow negative. You're bleeding. It's not really the investment game. So I am getting calls from sellers selling investment properties, but not, regular people that are just living their life and going on about their day. I haven't seen any distress calls on that end. I don't think any of my team has as well. We'll see if that's, going to start coming up in the near future, but there are a lot of reasons to think that might not happen at a high rate as many people think, and we're going to get into some of those reasons in a minute. But let's head off with this. What is this acronym?
Let's stay on that. Let's stay on that, right?
Let's do it.
So, because we were just talking about this. We actually were reviewing this article where Canada's Financial Consumer Watchdog,
FCAC, another acronym for you to know.
That's right, Financial Consumer Agency of Canada. That's what the acronym stands for. And they were doing research, and what they're finding is the research shows a growing number of Canadians are struggling to keep up with their financial commitments. And so, as a part of their research, FCAC's guidelines is supposed to help Canadians with mortgages who are experiencing severe financial stress to help them in a situation, and they're starting to come up with ideas and put some structure in place with financial institutions to help these individuals. So, how do you feel about that? And then I'll talk a little bit about some of the suggestions they're making.
Yeah, so the FCAC is starting to see signs of stress, and I want to get a little bit deeper on why this is happening. And one of the reasons we said that we don't really see a ton of foreclosures or people really stressing right now, there's a couple of reasons. Number one, wages are up big time over the past 2 to 3 years to help keep pace with the rising cost of living. Number two, like you said, people adjust their lifestyle. So you combine higher wages with, hey, you know what, I'm not going to go on 4 vacations this year. I might only do 1. And then thirdly, and most importantly, is the guidelines here. They actually, if I understand correctly, they've reached out to the banks and they've said, you need to work with homeowners that are experiencing certain levels of stress with their payments, right? So what are some of the options here that they've given to the banks to help distressed
Yeah,
homeowners.
And by the way, anybody wants to find this article, you can find this article on CanadianMortgageTrends.com. And so some of the measures could include, waiving any sort of penalties the client would have to pay in order to refinance or, restructure their mortgage, right? That's one of them, which I think is great, right? I think that sometimes people feel stuck because they have a penalty. Another one is waiving any internal fees or costs. And the third one is not charging any interest on the interest they owe already. So kind of compartmentalizing the interest that they might owe versus adding that all into the mortgage and charging interest on that interest. So that's interesting as well. And extending amortizations. This was the fourth one.
Yeah. And that's the biggest one in my opinion. You do see people with 50, 60, 70, 80, 90-year mortgages now on their amortization. And, okay, so we've got these headlines. We've got these news stories. We've got the quick Twitter posts about how the world is ending and all this stuff. But I always like to take a step back and kind of get a 10,000-foot view and kind of put some context onto some of these things. And I always go back to like the recommendations here to me, when you read between the lines, they're telling us that they don't want the housing market to crash.
Right.
Like they're doing everything in their power. The reason we're not seeing on the ground level people turning their keys in is because of these steps that the banks and the whatever it is, FCI, whatever it is,
FCAC,
OFC, all these acronyms,
OSFI.
They're all stepping in to make sure that the system doesn't completely collapse.
Yeah.
And then when I take another step further from that, and another 10,000 feet above that, I think, well, yeah, it makes sense, right? If I'm a government, the last thing I want is the middle class turning their keys into the banks and having a bank failure and a collapse, and then they all vote me out of power. Of course, I'm going to step in and make sure that the middle class is protected. Now, what's interesting here is I am seeing and feeling more stress in general, right? I don't see people turning their keys in, but people are actually starting to get worried now.
Yeah.
And if you remember 6, 8, 12 months ago, we'd come on these podcasts and we're like, you know what? I go live my life. I'm not seeing any differences. People aren't actually changing their behaviors. They're still going on all these trips. They're still spending money. And the reason that is, like, there's literally trillions of dollars printed into the economy. So even though they're raising rates, that money needs to come out of the system. That takes 12 to 18 months. Okay, so we're not going to see that immediate impact. And we also saw when they did pause rates last time, the general public said, see, they're not going to keep pressing. Now we can go out and live our lives. So it caused a reaction by the consumer to go back out and spend and buy homes, and we saw an uptick in the housing market. This is why they had to come in with another rate hike and why they might come with another one. They have to stomp it out. So I'm not surprised by this. I'm not thrown off guard. They're not going to ease off rates until inflation is completely under control.
Right. And
one of the big things you said on one of our previous podcasts was they did this in, I think, the 70s or 80s, where they eased off too quick and you had a double dip of inflation.
Yeah. So when you bring the rates down too quickly, it will stimulate the economy again. And so they want to avoid overstimulating the economy, right? And if they do that, that's going to create more inflation, right? All of a sudden, there's a big surge, people re-entering the market or spending again, right? Because the rates are coming down, they have a lot more confidence. So they want to avoid that. And it's funny, we're talking about, the emotion, right? So we go, several months of kind of people being afraid to do anything. They do the first rate pause. All of a sudden, we start seeing a surge. They do another rate pause, we see another surge, right? Now they do a rate increase last month in June. Confidence is still there. They do another one, and all of a sudden, the confidence is not there. 2 months in a row of a 0.25% increase. So 0.5% increase compared to, probably the 400 points that we saw last year. Just 0.5%, but still, it's almost like PTSD from last year, right? People are afraid, even though it's just 0.5% compared to what it was last year.
Yeah. And let me touch on that a little bit. The money's starting to run dry for people.
Yeah.
They were up hundreds of thousands of dollars in equity. They had money in the bank. Money was cheap. They've refinanced their home. It took a year or so, maybe a year, 12 months, 16 months, 18 months, whatever, for that money to start running a little bit dry and to start feeling a little bit tight in their wallets and to stop feeling as rich. Now your stock portfolio is down. The equity in your home is worth less. You're not paying off your mortgage anymore. Now consumers are going to start adjusting their behavior.
Yeah.
So in my opinion, the Bank of Canada, and they're searching for the breaking point. They're searching for that point where it almost breaks, where people really stop spending, where supply catches up with demand, where things balance out. And until they find that point, which it seems now that I'm actually feeling the fear out there that we're very close to it, but we're not probably quite there yet. And even when we find it, they're going to have to keep it. They're going to have to keep their foot on the gas for another 12 months. So they can't just ease off of it. So I do anticipate this kind of higher rate environment for another 12 months or so, if I had to guess, right?
Yeah.
That would be my best guess. But like, I don't look at it as the world's ending. I look at it as they overswung the pendulum way too far with easy money. Now they're overswinging the pendulum to where it's putting real significant pressure on people. But at no point do they really want the pendulum to swing where it actually breaks the whole system. So I think they're just trying to keep the system intact. And people will think, well, they can't keep it intact. The system, you can't do it. Everything's going to collapse and everybody's going to lose their house. When you can print money and when you can change the rules of the game and when you can make all of a sudden extend amortizations to 90 years or whatever the case is, when you can change the rules of the game at will, you can prevent a recession. You can prevent a mass housing collapse. So people are operating as if they think that there's actually rules to this game. There aren't any. Money's fiat. It's made up. They can print it at will if they need to. They can change the structure for mortgages to prevent collapse. That's why I'm not so sure we're going to see this mass collapse. Now, people are going to be under significant pressure, but I'm not calling for 30% of Canadians to lose their houses or anything.
Yeah, no, I would agree. I don't think so. They definitely want to avoid that at all costs. That's why they're putting some of these measures in place already, right? Like you said, the pendulum swing from one to the other. I think we're already overshooting with the interest rate. I think we've kind of already hit that resistance point. I don't see it going too much higher than this because we've kind of already hit that resistance point. I think the further they go, the further they keep stretching it, the higher chances of some of the Canadian families really negatively being impacted, and they want to avoid that.
Yeah, and let's talk about why. They had to raise rates so fast to overcorrect quickly.
Yeah.
They couldn't do a quarter point at a time. They got to a point where they raised rates very quickly, but it was all digested by the market because there was too much money. Now we're reaching that point where these %quarter increases are actually having a significant impact. I walked into the office today, people are like, oh my God, another rate. Like, this is really going to hurt me. I got to really think about things. I got to really, maybe I should sell my investment property. Maybe I should not, whatever the case is. People are actually starting to feel these quarter points when they weren't feeling the 400% prior.
Yeah.
The 400 points, like you said. So now these small tweaks are going to have double, triple, quadruple the impact of the previous 400%.
For sure. And you can find, like we were talking about, you can find this information on the Government of Canada's website, right? There's key findings, it's a key findings report that's released by the FCAC, which talks about, number of Canadian families that are starting to dip into their savings to keep up with their lifestyle or keep up with their bill payments, right? So I think the number was the percentage of families that are starting to use their savings to meet their financial commitments has gone up by 15% in the last year or so, right? So let's say the number was 20%, now 35% of families are dipping into their savings to meet their financial commitments, right? So
again, looking one level higher than that, that's what you need to have happen to slow the economy.
Yes.
If I have excess capital, what do people do? Most people, they go spend it.
That's right.
If I don't have excess capital anymore, in fact, not only do I not have excess capital, I actually have to dip into my savings. That's going to change my behavior very quickly. And then we're going to need another 6 to 12 months of changed behavior to allow the market to come back into balance. So if you actually take a rational perspective on this, this is exactly what we need and want.
Yeah, and this is the goal of raising the interest rates.
This is literally what we need.
Yeah,
now here's the funny thing: if they would have came out and paused or dropped rates or something like that while inflation was still like this, the market would have a similar negative reaction, in my opinion, which would be, oh my God, inflation's still too high. The system's going to, it would still be very negative, right? They should have raised rates again. So no matter what they did, the sentiment's going to be negative because inflation's still not under control. So this is actually the better move for long-term health, right? It's like you go to the doctor and they put a Band-Aid on your gaping wound versus sewing it up and stitching it up and fixing it properly.
Yeah. It's like pulling your, like my daughter has, my firstborn starting to get a lot of loose teeth, wiggly teeth. And, you almost kind of want to just pull that tooth out, right? Yank it out versus like drawing out that process. And I think that's kind of what we're doing here, right? We're increasing the rates. I think you had posted something on Instagram I saw where it was like 10 months in a row or 10 months in a row of the inflation dropping consecutively. Is that right?
Yeah. 10 straight months of declining inflation prints from the high, from 9.8% down to 3.2%. That was US data, but obviously we're very closely correlated. So it is working, but people think that it's just going to happen like that. But the game of money doesn't work that way. The money's already in the system. It's already in the economy. It's already in people's bank accounts. It's already there. It takes time to filter that money out of the economy and to start getting people to dip into their savings account. We're just at the start of that. That's why, we still have a ways to go here. But I'm not what I'm not recommending here is just mass fear, emotional decision making, and kind of this end of the world mentality where people are predicting it's going to be like the 1980s where they go up to 18% interest rates and everybody has to turn their keys in. I just
that would be
anything's
crazy.
possible, folks, but like I personally wouldn't be calling for that. Make your own decisions on how you see this playing out, of course.
Yeah, for sure. Couple other interesting articles that I think we should kind of review. One of them it's from a few months ago, but they were talking about how one of the ways to continue fighting inflation is through immigration, right?
This made no sense to me, but continue on.
I'll read you some of the quotes here, right? So this is one of the quotes is, monetary policy affects demand. By raising interest rate, we are moderating spending, and that will reduce the demand for workers. This has unequal consequences across sectors and across workers. So the other way to rebalance supply and demand is to increase the supply of workers. That takes time, and with inflation already far too high, pretty much the goal here is we need to increase the number of immigrants that are coming into Canada. So,
which also increases demand for goods and services.
Yeah, so it's like I'm reading this
housing.
and I'm going, Yeah. So like I think that continues to create like an upward pressure on the housing market still, right? So I guess it's in a way to fight inflation, but it's not going to alleviate any pressure of the housing market.
Well, I love what you said there. It's spread unequally across different sectors.
Yeah.
Right. And the supply demand imbalance in the real estate market remains so tight and unbalanced that I don't think we're going to see equal effects on the real estate market like we might see in other areas of the economy where maybe inflation's coming down. Maybe wage inflation is coming down because you have an excess of workers, like you said, right? But maybe inflation on real estate remains high, and inflation on other, trips and other high service goods where there's just too many people absorbing services, maybe those remain high as well, while other things are affected differently. You'll see this in a chart as well, right?
Yeah.
It'll break down inflation is down here, but it's up here. It's down, like fuel is down and shipping costs are down, but the cost of food is still remaining high because of the carbon tax and other factors in growing population. So it's going to be unequally spread, but the fundamentals of Canadian real estate from a supply-demand factor remain extremely strong. I think we're both agreeing on that.
Yeah. I think the last thing is, we've been talking about interest rates a lot today. But one of the things, obviously, the rates went up today. We just mentioned that, talked about how everybody's feeling. I don't necessarily know if this is the last hike either. I think that there may potentially be another hike, another rate increase before the end of the year, even another 0.25%. What do you think about that?
Yeah, I do agree. I think that's the most likely scenario. Because if they don't, the market's just going to shoot up again, especially the real estate market, and it's not quite stomped out. So you combine that with just regular seasonality, and the summer months heading into December are typically slower. And I think we're going to be in Windsor specifically. I think we're going to be on a slow downward price trend into the new year. And again, combining seasonality with a rate hike cycle, really, right? That's going to be 2 or 3 in a row. Then we're going to see a downward trend here. But also, when I look at the fact that the fundamentals haven't changed and we're still short housing, it's an opportunity for some people, if you have the right mentality, to be looking for opportunities, whether you're looking to buy a home, a forever home, or an investment property. Those might be the lowest prices we see forever, right? They might not be, but they might be.
No, I totally agree with that. I think that's the first thing I said. Was like, hey, rates went up. Like that's going to create opportunity in the market, right? If you've been waiting to buy a property, or if let's say you're thinking about waiting for the rates to go down, potentially that may not happen until Q2 of 2024. I think the way I look at house prices and interest rates is this is how I kind of look at it. And tell me what you think about it. So once you buy the house, so let's say you paid $400,000 for the house, that's it. that's your price. The price you paid for that home is not going to change, but the interest rate will change. So although you're buying that $400,000 or $500,000 house at the current interest rate environment, that interest rate is not forever, but the price you pay is forever. So I'd rather pay a lower price forever, the one time, and then have an opportunity to pay a lower interest rate later versus paying a higher price because the interest rates are down, because you can never pay a lower price once you've paid that high price, right? So
this is a great point. I think most people don't think about this, but it's much easier to buy now than it was in March 2022 at the peak of the market, competing against 20 people and prices at record highs every week. Every week it was a new high. And we those $1 million properties are now 750. And you're right, I'd much rather buy at 750 with a high rate, assuming I could afford it, right? I'm not talking about being over leveraged or anything like that, but then pay $1 million and be a slave to the rate.
Yeah, because now you've paid that price, and when the rates go up, you're going to feel a lot more, right? Versus paying a lower price, and when the rates come down, you're going to be super happy. You're going to be like, oh my God, rates are down, my payments went down. Versus the other way around. Oh, I paid a really high price with the low interest rate, but now rates are going up, so you're going to feel the rate increase significantly.
Yeah, and another factor on that is I don't know if the prices are going to be higher in the next 6, 12, 18 months in Canadian real estate or Windsor specifically, but I do know that in 30 years, sorry, I don't know, but I can say with quite a bit of confidence that, yeah, I lied. Well, I believe with the utmost confidence that in 30 years, prices will be higher than they are today. Yeah. Because of inflation, because of money printing, because of supply and demand, because of population growth. And if the 750 house today is worth $1 million in 30 years, that's $250,000 gain. That might seem like a lot today, but you have to understand at 2% inflation compound over 30 years, it's going to be nothing. It's not even going to be perceptible. Yeah. It's almost inevitable that prices will rise over that long period of time, which is why that lower base price is so important. And you just got to extrapolate your mindset to a longer term view to help get through these challenging times. So great way of thinking about it, though. I think most people are more focused on monthly payments and locking in rates, and they're not really thinking about, oh my God, this house is $250,000 than it was at the peak, less than it was at the peak. It's actually way better to buy now, assuming I can afford the payments. Great point.
That's it, man. That's all I got for today.
All right, good stuff. Good stuff. Love this structure. We will be back before the next rate hike, a couple weeks.
Hopefully before the next rate hike, right?
No doubt.
Yeah.
And we'll see you guys on the next episode.
Let's do it.